Morning, everybody. Thank you for another session. Today we are working on cash flow statement. Now, in cash flow statement, we'll cover 1, introduction; 2, methods; 3, preparation and presentation of cash flow statement. We start with introduction. Now, what is cash flow statement? The statement which shows the inflow and the outflow of cash over a given period of time. One of the statements prepared by a company for it to be published. The statement monitors the flow, the inflow and the outflow of cash in a company over a given period of time. What determines the inflow and the outflow of the activities taking place in a business, which are operational, investment, and financial activity. Net cash flow is the difference between the inflow and the outflow of cash over a given period of time. Net cash flow can either be positive or negative. Positive net cash flow takes place when the inflow exceeds the outflow in each activity. The negative cash flow takes place when the outflow is more than the inflow of cash in each activity. Terminologies. So these are the terminologies which are normally involved in cash. What is cash? Cash, it is money. Money is a medium of exchange. What is cash equivalent? They are all items which are liquid in form, apart from cash, which includes bank and temporary investment. Flow, it is the movement of cash into and out of business. Statement, it is a report. Net cash flow, the difference between the inflow and the outflow of cash in a business. Inflow means the cash which comes into the business. Outflow means cash flowing out of the business. Positive cash flow means when the cash inflow is more than the cash outflow. Negative cash flow means when the cash outflow exceeds inflow. Classifications of cash flow statement. So cash flow statement is classified into the following activities. 1, cash flow from operation activities. 2, cash flow from investment activities. 3, cash flow from financial activity. We start with the first one, operation activity. Now, what do you mean by operation activity? Under this activity, we determine the cash flow by the buying and selling of goods and services in a business over a given period of time. The activities show the day-to-day dealing of a business. Under these activities, we have both inflow and outflow. Now, we'll be checking on the inflow and the outflow. Cash inflow. The cash flow into the business in the following ways. 1, selling of goods and services. 2, cash received from debtors. 3, discount received. 4, commission received. 5, any other flow of income item. Cash outflow. Now, when do we experience cash outflow? So the cash flow out of the business in the following ways. 1, purchase of goods and services. 2, cash paid to creditors. 3, discount allowed, commission allowed. And finally, any other form of payment for direct expenses. Investment activities. Now, what do you mean by investment activities? The activities shows the acquisition and disposal of assets and long-term investment over a given period of time. Now, what causes inflow? Disposal of assets, disposal of long-term investment, interest received, dividend received. What causes outflow? Outflow is caused by purchase of assets, purchase of long-term investment, and purchase of options and future options. So these are the activities which causes the outflow, and then these are the activities which causes the outflow. So in our left is cash inflow, in our right is cash outflow. So in each and every one, cash will inflow in investment activities, cash outflow in investment activities. Now we come to financial activities. What do you mean by financial activities? The activity shows source of financing the company, determines how company got capital to finance its operation, inflow, issue of shares, issue of debentures, loans, borrowings. So these are the ways which cash can flow into the business. Blowing back of profits, outflow. Redemptions of shares when the company is paying for shares. Redemptions of dividends when the company is paying for dividends. Payment of loans when the company is paying loans. Payment of borrowed money when the company is paying for the borrowed money. Now, one thing we need to know is that there is a difference between inflow and the outflow as far as borrowing is concerned. Now, borrowing means there is no interest attached to it. Loans means interests are attached to it. Loans, you must have a guarantor or security. In borrowing, there is no security. So these are the cases which causes inflow and outflow. The sources of funds, issue of shares, issue of debentures, cash from mortgage, cash from loans, cash from borrowings. In cash outflow, we have the payment of cash, payment of shares, payment of debentures, payment of mortgage, payment of loans, and finally, payment of borrowed cash. Cash flow statement method. Now, these are the methods which are usually in the cash flow statement. One is the direct method, two is the indirect method. Now, what do you mean by indirect method? Now, in the indirect method, under this method, there is no adjustment to be undertaken. It is the simple method. When preparing this method, the following items under operation activities must be shown very clearly, and they are: 1. Cash from customer. 2. Cash paid to suppliers. 3. Cash paid to employees. 4. Cash paid for expenses. Now, this is the format. The format of cash flow statement. We have cash flow statement for the year ended, date, month, year. The first item is operation activities, which we are calling it A. Cash from customers, cash paid to suppliers, cash paid to employees, cash paid for expenses. When you total, you get income. Then cash from operation activities. So when you less income tax, you get cash flow from operation activities. Then we have investment activities. We have sales of assets. We have sale of investment, which is an inflow. Purchase of asset, outflow. Purchase of investment, which is outflow. Interest and dividend received, which is inflow. Now, when you get that, you get cash from investment activities, which is either positive or negative. Financial activities. In financial activities, we have issue of shares, inflow, issue of debentures, inflow, cash from mortgage, inflow, cash from loans, inflow, cash from borrowing, inflow, payment of shares, outflow, payment of debentures, outflow, payment of loans, outflow, cash from financial activities, which can either be positive or negative. Now, when you total all the net cash flow from operation activities, net cash flow from investment activities, and net cash flow from financial activities, you get what you call positive or negative net cash and cash equivalent at the beginning. You add you add net cash and cash equivalent at the end. What you get is net cash and cash equivalent at the end. So meaning that the financial activity determines the source of funds which are used in operation activities and investment activities. Now, this is the format of cash flow statement. In a clear mode, you can have that. This is a sample or the format of cash flow statement, which is clear, which you can get it in full form. Now, we go to indirect cash flow statement. Under this method, we make adjustment in the preparation and presentation of cash flow statement. The adjustment to be undertaken include the following: 1. Net profit before tax, adjustment of non-cash items, adjustment of non-operating items, adjustment of working capital, adjustment. The adjustment affects only the operation activities. So in our indirect method, our concern is only operation activities. The rest activities will remain the same. So this is the format of cash flow statement under indirect method. We have net profit before tax, which you give the amount, add non-cash and non-operating items, which can be goodwill written off, preliminary written off, sales of asset or at loss, in loss, loss from foreign exchange, depreciation, less non-cash and non-operating items, which can be appreciation, goodwill appreciation, profit from assets, gain from foreign exchange, cash flow before operating items. So you have it here. You total all this, you get cash flow before operation, before tax, net cash flow before working capital. So working capital increase in current assets, you less, it's an outflow. Decrease in current assets, it's an inflow. Increase in current liabilities, it's an outflow, it's an inflow. Decrease in current liabilities, it's an outflow. Now what you get is net cash flow before tax. Now when you less the tax, you get positive or negative cash flow from operation activities.